Hey everyone, welcome back to another episode. Today's guest is Tom Laune from, I didn't ask, you're from Nashville, right?
Yes, just right. I'm in the Nashville area. Just live
Nashville
south.
area.
Just south of Nashville.
So Tom is joining us to talk a little bit about infinite banking, which is something that I've been curious about. One of my first mentor in real estate, I met up with him about a year ago, and I was talking to him and I was just asking, like, what's the next thing that you suggest I should get into? And he said infinite banking was something that he was doing. So I was a little bit curious and I invited Tom on to talk a little bit about it. So welcome to the show, Tom. And if you just want to give us a little background on yourself before we dive into it.
Sure. Hunter, thanks for having me on. I'm super excited to talk to you. I'm always, looking forward to explaining how this works conceptually. And I will just tell you briefly before we get too deep into this that infinite banking is one part of my holistic strategy that I call the Bulletproof Wealth Strategy. So I have a little bit more financial background than the average person doing infinite banking just has like an insurance license, and then sometimes they get credentialed through the Infinite Banking Official Institute and they become what's called an authorized practitioner, which I did that at the very, very beginning of when that program started. So I've been in it as long as anybody in existence because I know I was in the very first program back in 2013 is when that started. But I've also kind of diversified with some additional stuff too. So I'm a chartered financial consultant, a chartered life underwriter, a chartered special needs consultant, and a retirement income planning specialist. So I take the infinite banking strategy, which is the primary vehicle by which I help real estate investors to increase their returns in real estate investing. But then I add a few other things to it that actually makes it more holistic and better guards your, ability to earn a living and some other things. And I call that the Bulletproof Wealth Strategy. Does that make sense?
Yeah. So it's not just the infinite banking
Yeah.
strategy alone. You have a bunch of things in your tool belt that you can help
Yeah,
people with.
exactly. Yeah. And sometimes infinite banking, honestly, is not the right fit for people. It really depends on where you're at in life and where you're at in your investor cycle, whether or not it makes total sense for you to start. So, anyways, that's just a little bit about, specifically what I do with real estate investors is I help them look at their total financial picture, where all of their money is flowing, and then try to figure out how to help them make sense of whether or not infinite banking is the right fit right now or not. So does that make
Cool.
sense?
Yeah, cool. So
Cool.
before we get into what infinite banking is really and all the tools that you have,
Yeah.
how did you start getting into this in the first place? What's kind of your background?
Okay. So my background is pretty wild. I started in music. Okay. So I was literally a music professional. I went to college. I have 3 undergraduate degrees in music related things. I have a degree in recording engineering, a degree in film and video production, and a degree in electronics technology. So that's how I started. And I was working in the music industry, ended up being a professional in that for 29 years. And I worked at really, really, really high levels. Okay. I mean, we're talking about, I worked with Bruce Springsteen, Mavis Staples, the Fabulous Thunderbirds, REM, like a lot of big artists, Stevie Ray Vaughan, just to name a few. But anyways, I was doing this engineering thing and I started to lose partial hearing in one ear. And because I had a financial professional that I was working with tell me, hey, you're making a really good living in music and all of your living is based on your hearing. Like I had to have perfect hearing to do what I did because I was literally mixing the records, really like putting it all together, the final touches on everything. So it was all about hearing. So I was advised to get special insurance on my hearing, which
Hmm.
is one of the things I now provide as part of the Bulletproof Wealth Strategy because I believe in it so much. But it is called disability insurance. And that means if you get sick or hurt and can't work, will you have an income provided for you? Okay. And very few people have this unless it's automatically provided in their work. Okay. So this is just part of how I got into this, right? So I started to lose hearing. I had this insurance that I was told to put in place. It started paying me this tax-free money that I could go and do anything I wanted. And I thought, well, I've got to find something that doesn't involve my hearing, but I love helping people, kind of make whatever they're doing better, which is what I was doing in music, believe it or not. That's why I was helping artists, sound better than they thought they could, have better production values than they thought they, knew how to get. And so I was just really accelerating what they were doing as artists. And so I decided to transition that into the realm of financial services because of that super important thing that I had. So it didn't start with infinite banking for me. It started with really a deep understanding of how important it is to have your income protected. And then I heard a podcast one day by a guy named Nelson Nash who was talking about this concept of saving money in life insurance versus a traditional bank. That's really what infinite banking at the core is figuring out an alternative financing methodology for your business that is going to be more advantageous to you than doing the traditional hard money lending and other sources of finance. Okay. So that's a little bit of my background and how I got into it.
Okay. So unfortunately, it was because of your hearing that you had to move over into doing something else.
Yeah.
But you had that experience
Yes.
with the insurance. How did this other person know to take out this policy? It's just by chance that they said you should take out some disability
Yeah,
insurance.
that's a
And
great question. So this financial professional I was working with just had it in his background that most people don't think about protecting their income. Okay.
Mhm.
So when you think about it, Hunter, how many people do you know that don't have insurance coverage on their primary home that they live in, right? If you live in a house, it's a 99.999% sure assurance that you are going to have that house covered with homeowners insurance. Even if you own it outright, people would never dream of not covering their house for insurance, okay? But how many people when asked, okay, what's more important in your life, your house or your ability to earn a living? They're going to say ability to earn a living, right? Because if they don't have that, they've got nothing really. And so
Mhm.
that is what disability insurance protects is your ability to earn a living, but nobody knows it's out there. And I was just fortunate that I found somebody who did realize that it was something I needed to have. And so that's basically, I was just very thankful, that they
Yeah.
brought that up, but
Yeah.
because I
So
didn't
it's
know it existed.
yeah, well, it's great that it worked out for you. Unfortunate that your hearing started to go away, but it's great that it worked out, and
Yeah.
now it's helping or it put you onto this path that now you're doing this for other people.
Definitely.
So
So I've been doing this since 2013 now.
yeah, so we're 13 years in now, so
Yeah. Yeah.
so pretty experienced. So that's great. So once you started to learn a little bit more about this, how did you start getting into infinite banking and like the whole everything that goes along with that?
Yeah. So, first of all, I went to a conference that I thought was on Austrian economics. And I went to hear an Austrian economist speak. And that lo and behold, the thing was Bob Murphy talking. And he is one of the guys who's you know, very, very early on adopter of the infinite banking concept. And he is a formally trained Austrian economist. So when I went to hear him speak, because I've always believed in what they call the sound money theory. I don't know if you have much background. I don't want to go too off the rails on this, but basically what it is that right now we're kind of operating under what's called Keynesian economics. And that is the structure we're in, which it's really not good, okay? Because that's why we're $40 trillion in debt as a nation right now. And what that means is that
Hmm.
you can create money out of thin air. And there's this thing called fractional reserve lending. And infinite banking solves all those problems because you're primarily using an insurance company as the vehicle to save your money in versus a bank. And insurance companies don't have the ability to do fractional reserve lending, which I'll just give you guys a quick basic on what that is. If you deposit $100,000 into a bank at a 10-to-1 fractional reserve ratio, the bank could lend out $1 million, even though they only have 100,000 on deposit. And back when we had the giant financial crisis, I don't know how many of your, people who are listening would be really, aware of this happening at the time. But it was in 2008 and 9, and those gigantic financial institutions in New York, Bear Stearns, Lehman Brothers, they were doing 50-to-1 capital reserve ratios, which means that if you had $100,000 on deposit, they were lending out $5 million. Well, now you've got all these risky assets out there that have no backing to them, right? They have nothing backing up. If the loan defaults, there's nothing collateralizing it so that they can go after it. And that's how we ended up in such a hot mess that we're in today. So what this concept of infinite banking does is it stabilizes the currency increase by using a life insurance company to stabilize, to actually save money in versus a bank. That's really what it does, because insurance companies can't do fractional reserve lending. Okay, so that's the foundation of how I started becoming interested in it, was just by understanding how money works and how money
Mm-hmm.
is created. And it's a rabbit hole. I'm going to be honest with you. If you start researching this, it kind of goes into a rabbit hole, but you don't need to understand every little bit of it. You just need to understand that this guy named R. Nelson Nash was a student of Austrian economics, and he came up with the concept of this because it actually puts a limit on how much money is created. Okay.
Okay.
If you put $100,000 in a life insurance company and have that as your cash value, you can borrow $100,000. You can't borrow $1 million with a $100,000 deposit. Do you see what I mean?
Mm-hmm.
It doesn't
Yeah.
work that way. It's a 1-to-1. They call it a 1-to-1 fractional reserve ratio. So it's not
Mm-hmm.
over leveraging money. That's the basically the problem that it solves.
Okay. So you got into this, you started going down the rabbit holes, right? Learning about all these different things. And that's
Yeah.
how you started to develop your bulletproof wealth strategy then, as you
Yes,
learned about
I
different ventures
combined
going
what
off of that.
yes, and I combined my personal experience of losing my ability to earn a living in an industry that I loved. And so how did I protect that? Well, disability insurance, where you combine that with understanding this Austrian economic concept of where's the best place to save money. Well, that's infinite banking. That has nothing to do, neither of those things have anything to do with each other, just to be honest with you, right?
Yep.
But when you combine them, and a few other things, that is what my bulletproof wealth strategy is. Okay, so I look at a holistic situation, of what is going on. First of all, Hunter, most people don't understand what life insurance is or what it's even insuring, right? They just literally, it's one of the most misunderstood products out there. Because let me just ask you this, Hunter: what is life insurance insuring? Do you know?
Uh, so that's when you die,
Yeah.
your policy money is going to whoever you have on the policy, right? So your
Yes.
wife or kids or
Yes, it's going to your
yeah,
beneficiaries, but what is it
yeah.
insuring?
What is it insuring?
Yeah.
I
I mean, I will
don't
tell
know.
you this, most people say it's insuring my life, okay? That's what they
Uh-huh.
say, but that's not what it's insuring, because they can't replace somebody's life. Does that make
Mm-hmm.
sense?
Yeah.
All it's doing, everything in insurance has to be replacing something, right? If you have car insurance and you total your car, what is the auto insurance covering? It's replacing your car. Does that make
Mm-hmm.
sense? There's also a
Yeah.
liability component that would replace damage that you caused with that car, but it's replacing something, right? A homeowner's insurance is, if your home burns down, it replaces your house. It's so easy to understand that. Life insurance is replacing your earnings. That's what
Okay.
it's doing. You're married, you have a family, you are earning money, you're no longer able to provide for the family because you're not there anymore. It doesn't replace you personally, it replaces your economic engine, your ability to earn a living, right? It's the
Mm-hmm.
same thing as disability insurance, only with disability insurance, you're still alive. Okay.
Yep.
So that is how what it is replacing. And then how it works is this. I'll explain to you this. They use what's called a 4% replacement ratio. And what that means, just to make it really simple, is that for every $1 million of life insurance you have, it replaces $40,000 of income. So that's $1 million. 4% of $1 million is $40,000, right? So if you're making $40,000 a year and you have a $1 million life insurance policy, then you are
Quick break for a read from our sponsor. This episode is brought to you by Direct REI. Look, if you're a real estate investor, you know leads are the most important part of the business, but finding and following up with those leads is time-consuming and expensive. Direct REI solves that issue. It's an AI acquisitions platform with a built-in CRM, and here's what it actually does for you. It sources the leads straight from the county property records, it skip traces and enriches your data, it writes your sequences and runs your campaigns across email, text, direct mail, and phone, where you can send tens of thousands of outbound messages per month for less than the price of dinner, all from one dashboard. It tracks every channel so you know exactly what's working and what's not, and when a deal comes together, you can send contracts and collect e-signatures right there in the platform. And here's the real kicker. You don't have to run all of that yourself. There's an AI acquisitions manager that's built in that operates the whole thing for you. It finds the leads, it launches the campaigns, it works every channel, and when somebody replies, it drafts the response back in your voice so it actually sounds like you and not a robot. It runs your entire pipeline in the background day and night and only taps you in when there's a deal that's worth your attention. You stay in control, you close the deals, it handles the busy work that's been eating your nights. There's a free plan available, so you're not risking anything to try it. Go to directrei.com, hit try free, and let it start finding you new deals today. That's directrei.com. Now back to the show.
Placing the amount of money you're making with life insurance. So what the theory is that you're married, your wife gets $1 million. She says, hey, I want you to conservatively invest this, Mr. Broker, for a 4% return, which means basically a high yield savings account of some sort, right? That is very, very, very stable and consistent. And then just the interest that it kicks off would replace your income. So if you're making $40,000, your spouse gets $1 million, they invest that at 4%, it kicks off the $40,000, then that's replacing it. Now, let's talk about the taxes on that real quick, because it's super important that you understand this. Is the $1 million that goes to your spouse in this example taxable?
I don't know.
No.
Is it?
So
No?
the $1
Okay.
million goes to her tax-free. If she was taking that money and earning 4% on it, and you got a $40,000 a year income off that $1 million, would that $40,000 be taxable?
If it was income, it
Yeah.
would be then, right?
Yes, it
Yeah.
is. So the
Okay.
point is, though, is that the $40,000 that you're making now that it's replacing is taxable as well. So the $1 million or the nest egg goes tax free, and then the income that is produced on it is taxable, just like your taxable income. So
Yep.
here's the problem, Hunter. Nobody understands what I just said. I mean, literally, I could interview 2,000 people, and everyone's going to be like, "Well, I went to my guy and told him I needed $500,000." And I'm like, well, where did you get that number? Oh, I just made it up. That's literally what I hear. You know what I'm saying?
Yeah.
99% of the time is people are just wildly guessing. Like there's no formula, no theory, no understanding of what they're doing or why they're doing it, or what
Mm-hmm.
to do if something happens. Do you know what I
Yep.
mean? It's
Yeah.
just this random kind of thrown hodgepodge numbers that people throw out. Or another common number I get is $1 million. Why did you need $1 million? Well, it seems like a lot of money,
Yeah.
those kinds of answers. But the reality is, if someone's making $80,000 a year, they need $2 million of life insurance to replace that. If they're making $160,000 a year, they need $4 million to replace that. So by and large, the general public is wildly underinsured for the economic engine that they're replacing,
Yep.
which is
Okay.
themselves, their ability to earn a living. Does that make sense?
Yeah. So that's another thing that you help people with is figuring
Well,
out that
yes,
plan of.
I absolutely need to make sure of what is going on in your life, and do you have the right amount of income replacement coverage, right? Now, infinite
Mhm.
banking can be a huge part of replacing that amount. So in other words, let's just say you were going to do an infinite banking policy for $1 million and that, but you really needed 2 million. Well, we would just add it onto it or supplement it with what's called a convertible term policy, which I do that all the time as well, so that later you could switch that other $1 million to another infinite banking policy, but you would start with a smaller infinite banking policy and then you would make up the gap coverage difference of what you need for income replacement with a convertible term policy. Does that
Okay.
make sense?
That I didn't follow so much.
Okay, so
That
let's just say this, Hunter.
yep.
You come to me and say, I want to do infinite banking, right?
Yep.
The first thing I'm going to do is I'm going to find out, are you married? How many kids do you have? Whether or not, if you're not married and have no kids and you're single, then this was a totally different discussion. If
Hmm.
you just had your eighth kid, right?
Yep.
And they're all under 10 years old, then you've got we have a lot more to discuss in terms of making sure that your family is protected. Does that make sense?
Yeah.
So
Yeah.
it's not like I just do one size fits all planning for anyone. And I specialize in working with real estate investors, and every single thing is widely varied based on your personal situation of what you
Hmm.
need. But the
Yeah.
but the thing where I think I lost you is if somebody needs an infinite banking policy, that's a specially designed whole life insurance policy to give you the most amount of money in it up to the IRS limits for the least amount of actual life insurance coverage. So you're literally putting in the lowest coverage amount possible for the highest amount of capital going in so that you can leverage it to use or borrow against it to use in your real estate investing world. Okay.
Hmm.
So that is not likely to actually cover your income replacement needs of insurance because it's literally designed to be reverse engineered to have the least amount of coverage
Okay.
with
So
the most amount of capital going in.
yeah. So going to infinite banking and the overall idea of it is you have the policy
Yep.
and you're taking out you can take out loans against that policy
Yes.
for the duration that you're alive, right?
Yep. Yep.
And then once once you die, then is it the opposite then where that policy doesn't pay out as much then because you have it set up as this infinite banking
Well,
strategy or
it depends on how you have the policy set up, but one of the things you need to know that is super basic when you think about it is that anytime somebody dies owning a policy, the policy no longer exists because it
Mhm.
literally only is viable or a policy up until that moment. And then at that moment, it transitions into something else completely, which is a big pile of money, right?
Yep.
So, how big a pile of money it transitions into when you pass away is completely dependent on how it was structured and how much loans you had out on it when you passed away. Let me give you an example. If you have a $500,000 cash value and $1 million death benefit, but all of the cash is loaned out of the policy and then you die, 500,000 of it's going to go to repay the loans and then 500,000 of it's going to go to your beneficiary. So
Mhm.
half of it would repay the loans, half of it would go to your beneficiary. So the point is that you're never all of your loans are always going to be satisfied even if they wait all the way until you die, right? But that's the reason they allow you to collateralize the policy is because they know that everybody's going to die someday. And so the loan's going to get paid back because the
Yeah.
death benefit is what pays back the loan. Does that
Okay.
make sense?
Yeah. So does that enable you to get a lower interest rate? Is that like the
Yes,
overall
because
benefit
yeah,
of
that's
that?
one of the mechanisms because as you know, that's a great question, Hunter. As you know, that anytime you have a very secure collateral, meaning collateral that you know is rock solid, you're going to get a better rate. And that's one of the reasons there's a very low interest rate on these loans. And the
Okay.
other cool thing about it is that these loans are also, you can't be turned down for them. In other words, they have
Hmm.
what's called a guaranteed loan privilege. That's what stresses real estate investors out. They find a great property they want to buy. They know they need to get either a down payment or some money together quickly. And so they go start looking around for capital, right? And this takes all of that stress out of it because they pre-save the capital that they need, but it's in a place that they're not taking it like a bank account. They're using it as collateral to borrow against at a low interest rate. Okay, so gets me to a super important point, Hunter. I want to explain to you how banks make money. Is that okay?
Let's do it. Yeah.
Because this is how banks make money, Hunter, and this is why you want to be a bank. All right. So if you personally, Hunter, had $100,000 and you went and deposited into your local bank, so you are giving them $100,000, is that an asset or a liability on their balance sheet? What would be your first thought?
Say liability because they have to pay interest on it.
Boom. You are absolutely 100% correct, Hunter. And very, very, very few people ever think like that. So I can already tell you're way ahead of the game because most people think, well, hey, any deposit must be an asset. But you immediately realize that they have to pay interest and they don't make money by paying you interest. That's not how banks make money, right? So now a guy comes along and he wants to take a $100,000 loan from the bank. Is that loan that the bank gives the guy an asset or a liability on the bank's balance sheet?
I guess it's an asset because they can sell it.
It's definitely an asset, yes.
Yeah.
Because let me ask you this. Do you think the bank is paying more or less interest to you on that 100,000 you deposited versus how much they're charging the dude for the $100,000 loan? What do you think they're making?
Yeah, they're definitely charging him more than I'm getting.
Yes. So let's say, Hunter, that they were paying you 3% and charging him 9%. What is the rate of return the bank is making?
So they're getting 6%.
Okay. And this is the problem why people don't understand how banks make money, because you're correct. They would be getting 6% if what? If one thing was true, and that is that if they were lending their own money. But whose money are they lending to that guy?
My money.
Yeah, they're not lending their money.
Yeah.
They put their money into specially designed life insurance products for the most part. They have billions and billions of dollars invested into what's called BOLI, which is bank-owned life insurance. What they're lending out is their investors' capital, and they're making what's called the spread. So what I'm explaining to you is interest rate arbitrage. This is how banks make money, all right? So if they're paying you 3% on $100,000, if 1% is $1,000, 3% is what?
3,000.
$3,000. So they're paying you $3,000 interest for you to deposit $100,000. All right. Now they are lending that $100,000 out to this guy that they found who wants to buy a rental property but doesn't have the capital, and they're charging him 9%. So how much is he paying the bank in money?
Overall,
9% of 100,000.
Yeah, so 9,000.
Yeah. So they're paying you 3 and they're charging him 9. Okay. So this is it. This is the key to how this works. If they're paying 3 and charging 9, they're not making 6%. Okay. 100% would be paying them 3 and making 6. That's doubling their money. But no, they're doing better than that. They're doubling it again, which is a 200% rate of return in this example. And that does not calculate in the fractional reserve lending we were talking about, where banks can lend out 10 times more than they take in. So the point of this is that you need to start thinking like a bank. And I teach my real estate investors to start thinking like a bank, because you can accelerate your returns by using more of other people's money, just like the banks do, right? They're not lending their own money. They're lending their depositors' money. Does that make sense?
That makes sense. But so what I'm lost at is, once you have this insurance policy, how do you loan it out? Like, you're loaning against yourself then, or
No,
where's this profit coming from?
That's okay. Here it is. This is very easy answer. So let's just pretend like you have started a policy, and over, let's call it a 4-year period. All right. So this is not a get rich quick scheme or where you just immediately start having all of this money that you didn't have before. This is where you're deciding to systematically save money in a place that is different than the traditional banking system, right? So let's say over a 4-year period, you've saved up to $100,000 of equity in your life insurance insurance policy, right? So now you've got the same $100,000 in your policy. You take a low interest rate loan, let's say 5.3%, which is what it is this year, right? And then you go put it into a property that you want to invest in. Let's say, I don't know if, do most of your listeners do flipping or wholesaling or hard money lending or multifamily real estate, or is it anything? Or what would you, what do
More
you think?
flippers, I'd say, probably.
Okay, so flipping is perfect for this. This is why I work with so many flippers. It's crazy. So what it is that the flipper then takes a loan at 5.3%. And do you think the flipper is going to do the deal if he doesn't think he can make more than 5%, 5.3% on his money? There's not a chance. There's not a chance, right? So whatever the flipper makes in this example on his returns is the equivalent of that 9% return that we just made up from the bank making, right? So
Hmm.
the investment risk is on what you're doing with the capital. It's not on the, there's very, 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 very low investment risk with putting money into the life insurance policy. It's one of the most stable, safe things ever. But where the risk comes in is what you do with it. Does the house that you pick to flip in a good neighborhood that you're going to be able to get a good ROI? Did you
Hmm.
run your numbers right? What is your it's the value that you're going to create. That's what flipping is all about, is creating value. Usually it's finding a distressed property that has lots of stuff that needs to be fixed up, but then you come in with a vision and are able to turn that thing around and actually I love flipping because it helps communities too. You're
Hmm.
actually making the neighborhoods better by doing what you're doing if you do a good job of rehabbing houses. So anyways, Hunter, that is how you do it, is you just use the money in your own business. And that's why this works so well for real estate investors.
Okay. So you have your life insurance policy, and to get that $100,000 in equity into it, that's something where it's kind of like a bank account where you can deposit into it over
Yeah,
time. Is that
yeah,
how
and
that
it's
works?
it's
Okay.
flexible. Yes, yeah.
So
Now
then,
there's an element of rigidity to it and an element
mhm,
of flexibility. So in other words, there's a have to portion that you have to put in once a year, and then you have an optional amount that you can put in, and that's what's called the paid up additions, and those are totally flexible.
okay.
Yeah, good
So,
question though.
so then you can take, so let's say you put $100,000 into it. That loan that you can take out is 1 to 1, right? So you can take out up to 100,000 of it as a loan,
Okay, so
right? Or is
that's a great question. It works nothing like what you just said. I want
okay,
you to understand that's not it at all. So
okay.
you don't get to pull out as a loan all of the money you put into it right away.
Hmm.
Otherwise, it would be a savings account. That's all it would
Yeah.
be. That's how savings accounts work. Because
Hmm.
there's an insurance component to it, usually I strive for around a 68% kind of, just to give you a general picture. If you deposited physically $100,000, we would try to be able to get you a loan for around 68,000 ish after
Hmm.
30 days. Okay. So you're not going to get all 100. But then
Okay.
eventually, what's going to happen because of the compounding growth inside the policy, because it grows, the money grows, and it grows whether you're using it or not because it's collateralized. So it's got internal growth factors. There ends up being more money in the policy than you ever put in from day one, usually by around year 7 or 8 of the policy. So this is a long-term strategy, right? So by year, let's call it 25, like you're way down in, you end up with double the amount of money in the policy traditionally. So if you put in $1 million by your 25th year, you're probably going to have 2 million inside your policy, something like that. And then you've been able to borrow against it the whole time at the increased amount. But it doesn't go net positive until usually around the 8th year. So the way I like to describe it, if you guys can see me, is like, this is the money you put in and this is the money you can get out. And then every year it kind of ticks like this, right? As it
Hmm.
goes, and it ends up being way more out than you put in. So it's a long-term strategy that also does multiple things, right? Because it's creating a life insurance estate as well. So it's protecting your income, and if you're not
Mhm.
married now, it'll do it when you get married in the future. You already have that covered.
Okay. I'm just trying to understand because that makes sense in that regard.
Yeah,
It's more of like a long term, like you want to have at least 7 years before it probably starts to tick the other direction
it is.
and
But the
you're positive.
important thing you need to know, and this is what some people get hung up on, is you don't wait 7 years to take a loan.
Hmm.
Okay. It's not that. You start taking loans right away if you have a property that's appropriate, right? If you have an investment that works, you start taking loans right away. And then when you make more money than your borrowing costs, then that's just profit to you.
Yep. That makes sense.
And your money is growing inside the policy at the same time.
Yeah.
So it's really unique. It works better when you can start it a little bit younger. And it also works better if when you start it, you're on the healthier side of life. And I'm not saying you have to be a marathon runner or you have to be in perfect health, but it doesn't work for people who are really unhealthy because there's an insurance component to it. So you have to medically qualify to do this as well, right?
Mm. Okay.
Um, and so it's a little bit where I have to show people what their actual numbers are. Like I literally go, okay, Hunter, this is your date of birth, this is your health, this is how long you want to put in money, and this is how your numbers would look. And that way they can decide, oh yeah, this is something it makes sense to me, or no, I'm not. I feel like this is not going to work for me. Because look, I'm just going to say, if you're 62 and you're wildly overweight, this is not a good plan for you. Does that make sense? Because it's going to be high cost of insurance and you don't have enough time for it to really do its thing.
Hmm. Yeah, that makes
But
sense. So
but I have clients, I do have 62-year-old clients, but not unhealthy ones.
that's how healthy do you have to be? Like for myself,
Yes.
I'm pretty healthy, but it's like if you looked at like a BMI calculator, I'm
Okay.
probably overweight, even though
I
I'm pretty
seriously
healthy.
doubt that, Hunter. Okay, are you comfortable with sharing how much you weigh
Yeah,
or no?
I'm like 195 and
Okay,
I'm
195 and how high?
5'10.
Okay, dude, you are right on the line for qualifying for the best rate class. It's
Okay.
195, 5'10",
Oh,
195. The next one is 209 at 5'10. So
okay.
it's more lenient than you think.
Okay.
Does that make
Yeah.
sense?
Yep. That makes sense.
It's not like crazy. Let me just say this: for you to be in trouble with your weight at 5'10", you'd have to weigh more than 254.
Okay. Yeah. That's then you have other problems at that point. So
Exactly. So you got plenty of room to go. You're totally fine. Yes. And so, yeah, it's just there's another compounding factor, and that is, of course, smoking, right? That changes the dynamic of the cost structure quite a bit. So it
Mhm.
just doesn't work as well. But again, I have people that tobacco use is a part of their plan, and we just make it work, but it's just usually a lot less coverage. In other
Mhm.
words, if you were going to do a $2 million policy as a non-tobacco user, as a tobacco user, it might be a $500,000 policy for the same
Okay.
money. Does that
Mm.
make sense? So
Yeah.
we just adjust things and how it works. It's about a 4x difference, believe it or
Yeah.
not.
Okay.
So anyways, I know that that's way down in the weeds, Hunter, but
Yeah.
uh,
I was just curious how healthy you had to be to get a
yeah,
good like the
well,
best
that's a good.
policy. But
Yeah, I
okay.
think that you're good. I mean, I really do. I think most people are pleasantly surprised. I
Okay.
really
That's
do.
good.
Yeah.
So just so I can wrap my head all the way around the concept
Yes, sir.
with what this makes sense for who would want to do it. It the benefit of infinite banking is that I can put money in and I can pull money out of it whenever, and it's still going to be earning like not interest necessarily, but it's compounding in the policy, so it's still
Yep.
growing in value, and
Yep.
I'm able to take the loan out at any time. So that's like the
Yes.
benefit of that compared to
Yep.
if I were to just put that 100,000 into a savings account. If I just go and use that money, then it stops earning on the side, right? So like I can use that
100%.
money, but then it's not earning on the side. So that's like
Yes.
the main idea of that there is that your money is still going to be earning while you're using it. Right. So is that, am I
That is a
understanding it?
yes, that's a very good way to put it in very simplistic terms, which I always struggle to get it down to, how somebody can really clearly understand it. But yes, what you just described is exactly right. If you are just putting money in a bank and then using that money every time you do a flip and then putting the new money back, you're interrupting the compounding of that money every time you pull it out,
Yep.
right? And now here's another thing. If you put $100,000 into a bank and it pays you, let's just say you find an amazing 4% return, right? So you got $4,000 of interest over a year, 12 months. Is that $4,000 that you had in the bank taxable or not?
That would be taxable.
It is. At what rate? Do you have any idea?
No.
It's at your ordinary income rate, which is typically your highest tax rate. Okay.
Okay.
So if you are being taxed at, let's say, 30%, that is going to knock that $4,000 down by 30%. And they call
Yeah.
that a little fancy term, taxable equivalent yield. Okay. That means what is your after tax rate that you made on that money? So if you earned that same 4% in a life insurance policy in growth, guess what? The tax advantages in life insurance are that the growth on the internal balance is never taxed if you do it properly, right?
Yep.
So it has a lot of tax advantages, which means that on a taxable equivalent yield basis, your growth inside the policy typically way outpaces what you would get in a stable environment outside of the policy. You
Mhm.
following me?
Yep. Yeah, that makes sense.
So you got to be careful that you factor taxes into everything you do when you're thinking about how to make your money as efficient as possible.
Yeah. Okay. Yeah, that makes sense. So another thing that I'm just thinking of how this would work for me
Yeah.
is if I put money into this life insurance policy, like the number we've been using, 100,000, if I put that in, does that have to stay? Hey, hope you're enjoying this episode. I just want to take a minute to tell you about Sell the Earth. Sell the Earth is my land investing program where I teach the exact systems I use to buy and sell land every single day. My team and I complete over 100 land deals a year, so everything you learn comes directly from what's working in my business today and not outdated strategies or theory. One thing that makes Sell the Earth different is it's constantly evolving. Real estate changes, marketing changes, and AI is creating opportunities that didn't exist even a year ago. As our business grows, the program grows with it. We continuously update the training with the newest strategies, AI workflows, automations, and marketing techniques that we're actively using to find more deals and operate more efficiently. When you join, you're not just buying a course. We meet every week on live coaching calls where you can ask questions, review deals, and learn from other investors and myself. If you want more personalized guidance, we also offer one-on-one training to help you overcome roadblocks and accelerate your process. Whether your goal is to close your first land deal, create another stream of income, or build a full-time land investing business, Sell the Earth gives you the systems, support, and community to help get you there. If you'd like to learn more, head over to selltheearth.com. Now, let's get back to the episode. And then, like, if I'm putting it above like the base policy minimum, if I put in $100,000, but then at some point I wanted to take it out in the future, if I wanted to close my policy or something, is that something you
Yep.
can do? Or okay.
Yes, you can absolutely do that. It's called a surrender. So you can get money out of your policies one of two ways. You can take a loan, which was what most people does because then the internal compounding continues, or
Hmm.
you can just get it out and surrender it. Now the thing is, if you do a surrender, and it's over the amount of money you put in. Let's just say you're 20 years in and you've put in $1 million, but now it's got 2 million. Then I'm going to highly advise you to not surrender more than the 1 million you put in,
Hmm.
because anything over that million, if you surrender it versus taking a loan, is going to be taxed at capital gains rate tax. Actually, sorry, it's going to be ordinary income. So it's going to be that $1 million is going to be taxed at ordinary income. That is the gain inside your life insurance policy. So nobody should do that. Right. But
Yeah.
it's not that you can't get the money out. It's just, will it cause a taxable event or not?
Okay.
And so the money you put into a policy is fancy, financial term. It's called your basis, right? So you can surrender up to basis.
Okay. That makes sense.
Yeah.
So then another question. So of course the life insurance company has to make money too. So you're putting money in kind of like, what is it, your base policy, your
Yeah.
base amount they have to put in per month. How
Yeah.
much of that is going to go towards your I don't know what you call it, your bank account. It's not a bank account,
Uh,
but like your amount that
well,
you can pull out.
Well, I just explained to you that if you put in $100,000, you could pull out about 68,000 the first year, right?
Hmm.
And then after about 7 to 8 years, you can pull out as much as you put in, and then eventually
Okay.
it's more than you put in. But the cost to do this obviously is baked into these numbers, right? So there
Hmm.
is a fee to own permanent life insurance because guess what? It's guaranteed to pay out. It is
Yeah.
going to pay out. It's not like traditional term insurance where it only pays out a couple of percent of the time. It's going to pay out at some point. And so there is a cost to do it, but it's baked into all of the numbers, meaning that every number that I ever show a client, it's after all fees.
Okay.
Does that make sense? So it's not like
Yeah.
you get it, there's no hidden gotchas anywhere. So
Hmm.
if you understand how the numbers work, and I've done a good job of explaining it, then you know these are what my numbers are, and this is after all fees are taken out in order to get the insurance itself. But yeah, it is a product. You're purchasing a product, and it is a very, very valuable product. And some people, me included, think it's more valuable to have this than it is to have homeowners insurance. It really
Yeah.
is. I mean, it's just protecting way more. It's protecting your ability to earn a living. And that is necessary in varying levels depending on how many people are depending on your income. Okay. If it's just you, then we structure it to where it's the least amount of life insurance you could possibly have because there's no one depending on your income. But if it's you, a spouse, and a bunch of kids, or even one, it's like now you have these financial responsibilities and you have to account for all of that. Does
Yeah.
that make sense?
Yeah. Yeah. That definitely makes sense. And I really think I understand this a lot more than I did 45 minutes ago because
Good,
at the
man.
beginning I was still trying to understand like why you'd use it and exactly kind of how it works. But yeah, I definitely understand a lot more of this now.
Well,
So,
let me just tell you a smidge about how that I actually work. So I have a website. It's bulletproofwealth.info. And if you go there, you just put your name and email in, and it gets you access to a bunch of training videos and all these podcasts I've been on and all kinds of great information that's totally free. Then if you book a call with me, I ask for a bunch of financial information because look, if you really want to talk to me on the phone, I mean, on a Zoom call, then I need to know what your numbers are. And that means that I need to know where you're saving money, how your health is, how many kids do you have, all this stuff. And it's important because then when we get on a call, I can go, okay, I've looked at everything. Let me ask you a few questions to clarify, and then let me show you what you're able to actually do or not do. And then we can have a much more productive conversation. Does that make sense? So that's what I do is just
mhm.
book a strategy call. And my first call with people usually runs about an hour and a half, believe it or not, because it takes that long to go through all the details and explain to people exactly how it works. And then you make an educated decision whether or not that it will work for you or this is something you're ready to do or not do. I will tell you this, for real estate investors, a really good time to think about starting this is right after you've just sold a property and you have a windfall. Right. So you've just sold a property and you made 50 grand. Right. And now you've got that setting in your account. This is a great time to look at repositioning that to start a policy. Right. Because now we can immediately have some forward momentum on getting something going for you. So I like to catch real estate investors after a good property, sale that they've just made, or they've had a rental house, they decided they don't want it anymore, and they're going to just get a bunch of capital back on that rental because it's appreciated, and then they liquidate that. Then that's a really good time. Just in terms of when is the right time to do it, it's after a recent equity event or liquidation of some sort.
Hmm.
Does that
And
make sense
sooner
to you?
is better, it seems too, because in
Yeah.
order to hit that 7 year period, if you start it now, it's going to work a lot
Yeah,
better compared to if you wait 5 years
100%.
and start it then. So,
And I'm also, yes, that's true. And I'm also happy to help people that are like, hey, I've got 3 houses on the market right now. What can I do just to get started? And what we do is get them through the medical part of it. right? We
Hmm.
get them qualified to own the policy so that when they're ready to make that investment for infinite banking, then we just can switch it. You know what I mean? Then it's a quick transition, because one of the things that is a bummer is I know how real estate investors like to have access to capital at all times because they don't know when a deal is going to come along, right? They have no idea. So this gets people pre-qualified to do it, and then when they're ready we just do it quickly. That way they have a very small window of being, not liquid, if that makes
Yeah.
sense.
Yeah. That makes sense. One
Yeah.
one thing quick I just thought of because you brought it up with getting getting a loan on your policy. How
Yes.
quick is that to do? If somebody
It's
had their money in it, is that something that can take a week,
it,
a month, a day? Or?
so yeah, great question. So it depends on how you're accessing the capital, but if you're borrowing from the insurance company, which is what primarily people do, that's a 7 day, and it comes through ACH, meaning like it will be just plopped into your bank account from the insurance company. Now they can write you a check and mail it, but that takes a little bit long. But I usually want a week's heads up, and there's always the option of putting a rush on it. And usually we could get that down to maybe 5 days or something. But, it's not write a check at the last second at 4:59 on a Friday kind of thing. You have to have like a little bit of heads up as to when you're going to need the money. But I don't think 7 days is egregious.
That's pretty good. Yeah, that's a pretty quick loan. So
Yeah. Yeah.
cool.
And it's
Okay.
guaranteed. So it's not like you're asking, can I qualify? You're just saying, send me the money. And that's just how long it takes to do all of the processing. And one of the things
Hmm.
that's kind of cool is that there is a loan form, but because I work with real estate investors and I'm in every state, I didn't even ask you, what state are you in, Hunter?
I go back and forth, Nevada and Minnesota.
Okay, cool. So, because the process is, varies on a state by state basis, just know that there's slight differences because insurance is regulated by the state. So, we would want to look at everybody's situation and go, okay, these are the provisions for Nevada, these are the provisions for Minnesota. But in terms of getting a loan, it's always 5 to 7 days, and it's really easy. And the point I was trying to make, I just remembered, is we do the loan processing paperwork for you because I work with so many
Okay.
real estate investors. So all you're doing is telling me you want a loan. I ask you how much, and then you click a button, and basically you're just e-signing for the thing, and then boom, the money is on the way.
Simple.
Yeah,
Cool.
I make it really easy. Yeah,
Yeah,
because I know that's
that's
one of
nice.
the most important things is people need to get the money as quickly as possible. So
Hmm.
I have an operations manager I work with that takes care of all those loan requests, and it's great. It really is good.
Awesome.
Yeah.
Nice. That's cool. It's good. It's set up well and it works easily for everybody. So that's great. So if people want to reach you, they should go to your website. It's the
Yeah,
number one spot to
yeah,
do
and
that.
it's kind of tricky as it's not .com. I don't know why, but I've tried for years to get the .com. I do have the complete trademark registration. Everything is official on the name Bulletproof Wealth, okay? But I
Hmm.
can't get bulletproofwealth.com because somebody who doesn't use it bought it like 25 years ago, and they won't
Tough.
communicate for any reason whatsoever, which is just beyond frustrating. So it's
Yeah.
bulletproofwealth.info. And hopefully can you put a link in the podcast to it?
Yep. Yeah. That'll be
Um,
linked below. So if
oh,
anybody wants to check out your stuff and talk with you, it'll be
yes,
below in the show notes.
that would be great.
Awesome. Cool. Well, I think you helped me a lot, and hopefully the people listening that had a very basic understanding like myself now understand it a little bit better now too. So I appreciate you explaining it, and if they want to reach you, they know where. And thank you for your time.
Thank you, Hunter. I really appreciate this. It was a great talk.
Awesome. Well, thank you.